properties in the news. And while there are more good news stories now than there were at the beginning of the year, there's so much conflicting information. So to bring some clarity to some of the recent news stories, let's have a chat with Australia's leading housing economist, Dr. Andrew Wilson, Chief Economist of myhousingmarket.com.au. Hello, Andrew.
G'day, Michael. How are you today?
Good, thank you. Lots of news stories to cover. And the first one is the property market recovery real? One of the interesting stories creating some debate in the last little while is whether there actually is a property market recovery in Melbourne and Sydney. There's been the talk about the two big organisations, realestate.com and CoreLogic. CoreLogic say we've had 5% growth in the last quarter in Melbourne and Sydney, and RBA are not noticing that at all. What is your research showing?
Well, without commenting on the validity of those particular organisations and their track record in accuracy, we'll sort of move on from that. But certainly we have a revival in the housing market, Michael. Generally, there's no dispute about that, surely. If one business isn't doing particularly well, they perhaps should look at their business models rather than the metrics for the housing market, which clearly show a revival. I mean, we've had clearance rates rising to 80% in Melbourne and Sydney. Of course, that has translated into strong prices growth. Prices are growing in Melbourne and Sydney generally at the fastest rate in years. In fact, at the fastest rate really that we've seen. But we've got to really understand the market here, and this is where we seem to miss out in terms of a lot of the commentary, and that is that the Melbourne and Sydney markets really are moving strongly upwards in isolation because they've got the most to gain because they fell the most during that quite a remarkable decline phase in the market last year, which was generally created by, firstly, of course, by higher interest rates directed at investors, and then, of course, a crisis in confidence. So we're seeing that catch-up energy now driving prices in Melbourne and Sydney. It's because notionally buyers are buying at a discount because prices are still below where they were at their peaks in Melbourne and Sydney 2 years ago. Now, once they regain those peak levels, which is likely to be over the next 6 months or even sooner at the current rate of growth, then we'll see what happens in terms of market dynamics. And there are some forces which will continue to push prices upwards, but I believe they will certainly taper off once we get back to those levels of prices that we've had at peak levels in 2 years ago in Melbourne and Sydney. And that's why, Michael, the smaller markets are not producing the price growth that Melbourne and Sydney are, because those markets didn't fall at anywhere near the levels that Melbourne and Sydney did. And of course, they remain around about their peak price point. So lower interest rates have not had the same effect on those markets. And the reason we have low listing numbers in Melbourne and Sydney relatively, and that's starting to ease now with the listings on the rise, is because notionally sellers would be selling at a discount in terms of where their prices were 2 years ago. This isn't rocket science, Michael. It's quite simple stuff, really.
The other thing is that rise in prices is being driven very much by owner-occupiers. Investors aren't in the market as much. So I agree with you that there isn't going to be another boom ahead because owner-occupiers are going to be very constrained by finance. Another thing that I read this morning in The Australian was an interesting comment from what they call a panel of experts, anyway, we'll leave it at that they declared Australia's dangerously obsessed with housing, pinning the blame on tax rules that lured waves of baby boomers into investment properties and fueled by unsustainable credit boom. Andrew, I think Australians are obsessed with housing, but it's because they want to live in a home. They're aspirational to own their own home. But are they obsessed by tax cuts and are they really lured into a credit boom?
Well, I think that it's a dangerous obsession to be a wealth generator, Michael, and to be prosperous. And certainly property has proven to be the pathway to prosperity, and certainly history has shown that. Yeah, look, it's just another, I guess, exciting headline designed to generate the sort of clickbait that these things do. And of course, I guess we do start to question that throwaway line of experts. And we are seeing first home buyers rushing into the market now. No surprise, given prices are rising. First home buyers are always activated by a rising price environment in the early stages of a market revival because they're fearful that they won't be able to keep up in terms of raising their deposit with higher prices. So regardless of the notions and the exciting headlines that so-called experts generate, they're largely ignored by the greater majority of the populace who continue to vote with their feet and purchase properties, and certainly continue to understand, perhaps in their heart of hearts, that this is the pathway to security and financial prosperity.
I think that you've got hit the nail on the head there, Andrew, that there's nothing wrong with wanting financial security. The latest wealth report from Roy Morgan showed the Australians who own a property actually are more financially secure in their golden years than the Australians who don't. Most Australians' wealth is in property or their superannuation, and for most it's their home. So nothing wrong with that. And for those who want to get ahead and get on the property ladder and use property as a form of extra wealth creation, I don't see a reason to say that's an obsession. It's some security we're looking for. In the last week, there's been some finance figures have come out as well, and it's shown that owner-occupiers are driving the housing rebound. The September housing finance approval showed much stronger than many commentators expected rise in owner-occupier loans, but there's been a bit of a pullback in investor loan approvals. And some of the reports said owner-occupier loans surged. But the graph that we're showing now that you've provided shows you've got to say compared to what?
That's exactly right, Michael. And it goes back to what I said previously. We are coming from a low base, and we have seen an increase in owner-occupier lending over the last couple of months. It was probably a little flatter over September compared to August, but still strong compared to earlier in the year. But when we look at the year-to-date data compared to last year, it's still well down, and the breakdown shows that investors are still lagging. So we had rises in owner-occupier lending over September, again following a strong rise in August, so it maintained its energy. But when we look at investor lending, which I thought was quite sobering, Michael, it actually fell over September. So investor lending was down, which I think is another reflection of this almost schizophrenic banking environment that we have, where banks are reporting significant declines in profits, most banks, because their loan book has fallen. And yet, obviously, there's still some trepidation from banks lending generally, and particularly to investors. It shouldn't be a surprise that we are seeing significant declines in profit from banks due to lower home lending, when we see just how far a lower lending is this year compared to last year, even though it is rising. So there's a long way to go before we get back to where we were, Michael.
I think that also gives us an indication of what's ahead, because owner-occupiers create the long-term growth in property values, but it's the investors that create the booms, or when they disappear, the downturns, and the investors aren't there at the moment. Even though they're keen to, they can't get the finance. So it's unlikely that we're going to have a boom moving forward, much more likely the more moderate growth that you've been predicting for a while, Andrew.
Yes, Michael, that's right. And we've almost moved into this quite bizarre systemic environment for home lending. The banks at the one end are obviously concerned about lower profits, as would their shareholders be concerned about that. In fact, one of the bank's back-end lending requirements fell below the APRA benchmarks, which was really concerning because of its lower profitability. So, I mean, the way you move back to profitability is to lend more. I'm not sure where this constant concern about risk in the housing market comes from. Banks have been spooked by the regulator, the RBA, the Treasury, and ASIC into thinking that we're some sort of fundamentally unsafe housing market. And of course, despite their loss of profit, they still haven't got the courage, I guess, in a way, or the good sense to start lending again, particularly to investors. Another interesting factor from the announcement of lower profits from the banks was that I read that the actual decline in tax take from the big banks is now over $1 billion, which of course is revenue to the government. So I guess that over management of risk, which was cheered along by the government, they've actually shot themselves in the foot here, but having a significant decline in their revenue. This is really a bizarro world environment we're in, Michael, and banks need to really sort of shake themselves up a bit here, or they're going to continue to lose money and become under significant pressure from their shareholders.
Recently, the CBA released its results, and they showed that mortgage arrears and mortgage defaults actually in decline.
Well, look, of course, we've had significant media, and I don't want to keep hounding the media. It's not the media, it's I guess those that promote these negative doomsayer scenarios which get into the media that we should be looking at more closely. And of course, the debt bomb has a big part of that negativity. ridiculous predictions of collapses in our housing markets based on issues to do with the capacity of mortgage holders to repay their mortgages. Well, the latest CBA data shows that, and we should mention the CBA have actually had an improvement in their loan book. So they've sort of gone against the tide compared to other banks, which have had obviously significant readjustments in terms of the number of loans they've been writing. But the CBA announced also that its arrears had actually fallen. The number of mortgage arrears on their books had actually fallen, and they suggested it was because lower interest rates and the tax cuts that mortgage holders were actually paying down their mortgages. So not good news for the doomsayers, not good news for the debt bomb purveyors of nonsense, but I guess it just validates our points of view, Michael, that this was just a fast food media hyped up environment, and that Australians are quite circumspect about their debt, and given the capacity to have some extra money through lower interest rates and tax cuts, they're doing what predictably they would do, and they're paying down their mortgage debt.
Now, there was an interesting announcement from the RBA this week, maybe a bit of a concerning one,
Yes.
that they're revisiting their forecasts.
Yes.
What do you make of that, Andrew?
Well, no surprise, Michael. We can clearly see now the long-term trend has incomes growth, and that means inflation and economic growth lower than had been predicted. But it just does really reinforce that we are in this new economic environment now, that monetary policy has been muted, that we need to think of other ways of stimulating economic growth. It's the end of the roller coaster ride in terms of interest rates and therefore economic growth, and that means generally house price growth as well. And it's a whole new world, Michael, and the Reserve Bank have reinforced that by saying that they don't expect any revival really in interest rates or inflation or really economic growth over the medium to longer term. And this, of course, is a conundrum that's facing most advanced economies. And
some people haven't caught up with this, though, Andrew. Only yesterday, I was listening to a podcast from a so-called expert who was saying, be prepared for interest rate rises again. The old commentary, where? Why? Why should it happen? Now, I'd be really excited if it did, because interest rates will rise when the economy booms, when there's asset growth, when there's wages growth, when there's property value growth. So the Reserve Bank's going to try and slow us down. But that's not coming for a while, yet they're still saying, watch out.
Well, Michael, anybody who's promoting the prospect of higher interest rates has to be asked. It's one thing to say, well, interest rates are going to rise eventually. Well, yeah, whatever. But you have to be able to, I guess, verbalise what the circumstances would be for higher interest rates. Now, let's move away from the effect and start talking about the cause. And of course, that's when you get the blank look of uncertainty and plain ignorance, because the only, I guess, rationale for higher interest rates from those that purvey higher interest rates are to come is the fact that they've risen before. Well, that's the problem the Reserve Bank has got into, has been looking too much in the rear vision mirror in terms of what's to come in the future. Now, the Reserve Bank has to rely on, of course, some type of analytical process that does look at history, but we're obviously moving into a new environment, and the prospects of higher interest rates would only come two ways. One would be a serious currency crisis, and the second one would be if we had an economic boom where we saw inflation running back over 3 or 4%. Actually be predicting that, you've got to look at, well, where would the boom come from? Another mining boom? Well, that's not going to happen. We've seen a mining boom per se this year with the value of resources has increased. The demand for resources has increased. This has been good news for our export sector in iron ore and coal. But of course, we're not building the mines anymore that created the jobs and the economic growth that fueled our past two mining booms. So even if we got that, which we've sort of had, it's not going to create the same sort of energy that we've had previously. And there are other big drivers of economic growth, which are construction and retail consumption. They're just going nowhere. And in fact, we're heading into a very subdued period of construction, thanks to those higher interest rates that were placed on investors and the restrictions to lending on developers. So I don't know where all this growth is going to come from that's going to fuel the inflation that's going to end up pushing up interest rates. I'd like to have the answer to that question from those that are saying that interest rates will rise again.
Well, of course, people don't have to justify their claims, and that's why they're continuously there in the media, which gives us a great opportunity to get together once a week and debunk some of those myths and put some thought behind the commentary we're putting together. So once again, thank you for giving us your commentary on that, Andrew, and look forward to catching up with you again next week.
Thank you.